value and momentum cannot be arbitraged away. I mean, why do you think?
Well, I didn't say cannot be.
Or
I said I think they have to.
Yeah. Why do you think so?
I just wrote a piece on the web on this. I blogged about this. The title was the very non-poetic, how can a strategy work when everyone knows about it? It's exactly this question. First, you back up and you go, why do these things work to begin with? It could be risk, it could be behavioral finance, or it could have been data mining. They were never real. I do think we have enough so-called out-of-sample evidence, both through time and different markets, that the chance it was just data mining is quite small. Not zero. I like to say in 1988, maybe you woke up once a week afraid that you just got lucky. You ran the tapes and value seemed to work for US stocks. When it works for the next 25 years and works in 25 different places, you wake up once every 3 years in a cold sweat, but there's still a chance you just got lucky. But let's dismiss that. But the other two, risk. Risk should not be arbitraged away. There's no reason risk should be arbitraged away. It's a rational payment. Somebody doesn't want to take the other side. So I often think, if I had my druthers, I don't have my druthers, but if I did, do I want it to be risk or do I want it to be a mispricing? I don't know. Risk stinks because it's risky. When you get hurt, it will tend to be very painful times. There's probably a reason. Having said that, there's no reason to really worry about it going away, which is quite pleasant. Picking up risk premium should work. Behavioral can certainly go away, and it can go away in two different directions. It can go away, not because it's arbitraged away, that's one way. Too many people like me try to do it and we close the gap. It can also go away because people learn and stop making the mistake. Right? They are the suppliers of the return. We are the takers of the return. It can go away because too many people try to take or nobody supplies. I must tell you, maybe I'm a cynic about human nature, but having lived through two of the craziest financial markets in the last 100 years, in the last 15, 16 years, I don't worry particularly about the world learning these things and getting smarter. Have you watched our political nomination process? I don't spend a lot of time worrying that the world's suddenly getting rational. The arbitrage case, which is the one you brought up, is the most real. Too many people like me trying to do it. Here, I flat out just go to the numbers. And this is what we do on the site. Some strategies are very hard to get a sense of where are they now. Momentum is hard to say how much money is tracking it. Value is very amenable, and it's kind of the grandfather of all these strategies, the grandparent. When it comes to factor investing, style investing, smart beta investing, value is kind of the first of all of them. And literally, it's one of the most amenable to saying, where are we now? Take this price to book strategy. And again, they're more complex now, but let's stick with the simple one. You have your long, cheap, short, expensive. So take the expensive price, divide it by the cheap price, diversify portfolios. The expensive will always be more expensive, or else you're just doing it wrong. If you sort it on price to book, and the expensive don't have a higher price to book, check your spreadsheet. If you do this on the top third minus bottom third, it's varied between about 3 to 6 times more expensive. The most expensive price to book has been about 3 to 6 times, with variation kind of a channel. Tech bubble was the crazy time. It blew up to 11 to 12 times. That's where the expensive got nuts. And any valuation metric showed the same thing. It wasn't price to book. We are right now on this metric dead on historical average and median. Almost exactly there. When it comes to something arbitraged away, I know of no. First of all, I absolutely admit the possibility. To say it's impossible is crazy. Of course it can be arbitraged away. There's a lot of theory that says it should never be arbitraged to zero, because arbitrage gets riskier and riskier. It's not. We call it arbitrage, but it's not. It's a behavioral premium that loses sometimes. It's not an arbitrage. And when you arbitrage it half away, you get half the return for the same risk. So it should never go to zero, but could it be reduced? Yes. Is there evidence? Not really. The things we can track seem to be priced at fairly normal historical levels. I do think it's incumbent on us, I tell our clients, to keep tracking this. Particularly easy for value, much more vexing for some of the others. I admit we don't have very good measures, but I like to think too, value is a bit of a bellwether. If that's not gone, I have trouble coming up with a story why momentum would be gone. So tracking this, if we ever see it smashed down, it can never go below 1 for the reason I mentioned before. By construction, I'm doing expensive over cheap. But if it got near 1, or even well below this channel of 3 to 6, if it went down to 1.5, that'd be some real unprecedented territory, saying the market is no longer giving wide dispersions in valuation. Why would you want to assume long term you're going to make the same money, or even any money on a value strategy. So if it ever goes away, I think it's incumbent on managers like us to track it, and I have to admit, again, this final time I'll use this example, I don't even know what I root for. If over the next 10 to 20 years it goes away, that tends to be a very good 10 to 20 years. Being arbitraged away is very unpleasant going forward. It's a very enjoyable process as it's occurring. Because what does it mean? It means someone's buying what you're long and selling what you're short. That closing is the price going up on something you own. So if that happens, those of us who maybe have 15-year career horizons look very, very good. My younger colleague Jane gets to take over in 15 years, and I say, Jane, we've had an amazing 15 years. We've become legendary. Everyone thinks these are awesome returns. You're in charge now, and by the way, you got nothing. That could happen. Of course, what I root for doesn't matter for Hillary. It's going to happen, but it's going to happen. You might notice I don't give the short answer, but the short answer is we don't think it's happening yet, because the numbers aren't there.
How do you choose a good business partner?
Well, John, I have two business partners in starting our firm. I do think these will be trite answers, but I think they're trite but true. Obviously, ability is up there, but that's the easy one. But John in particular, I knew since grad school. I was John's TA in Farmer's class. He was a year behind me. Not everyone of your friends turns out to be a great business partner, but I had a lot of trust for John. David I had gotten to know very well at Goldman. It wasn't just a marriage of opportunity. We worked together for a number of years. These were very talented people I trusted. I don't know a magic past that. Do you have a magic answer to that one?
No, lots of questions.
Dan? Please.
For the momentum and event-driven, maybe the momentum have the trend mean reversing some kinds of that, and event-driven maybe have the pricing shock and reaction later. There will be some situation, and if the momentum strategy have the more explanation for the market, and the other kind of situation, maybe the event-driven have the more explanation. There will be some kind of situation there's a conflict, or they have the different result of the output for predictable market.
Is there a question in there?
Oh,
I don't necessarily disagree with that. Let me just say, if it's as you just described, that these strategies work at different times and for different reasons,
yeah,
that's pretty good news. What you want, kind of the holy grail, is putting together a bunch of things that go up on average that have as low a correlation as they can. Negative is the holiest of grails. Zero is wonderful. Two things that diversify each other to the extent they're unrelated but both go up on average. So yeah, the things that make event-driven, it's not like a merger or arbitrage. That's the most famous event-driven kind of strategy. A merger is announced, and we do this too, and this also hurt in the GFC. A is buying B. They start out here. The day it's announced, A is buying B. It goes to here, but if the deal goes through, it's going to go to here. Why does it not go the whole way? There are all kinds of theories on this. One is a lot of people own undiversified portfolios and just got a windfall. To go the whole way, they want out. They want to monetize their windfall. Because this is now a very risky situation. If this merger doesn't go through, you're going to give it all back. So those people who were the arbitrageurs go buy B and sell A to try to get that last little bit. What does that return profile look like? It makes a little bit of money most of the time, and it utterly destroys you occasionally. If you tell someone this pattern, I have 11 and 12-year-old kids. I keep wanting to try this. I'm scared because I don't know if it would work. If I describe this return pattern, this is the kind of thing I might do with my children. It's a little odd, I know. Describe this return pattern and say, do you like this investment? Your first reaction would be to say, no, I could make a little, I could lose a ton. Why do I like that? The proper question, which I would kill from my daughters or sons to answer this way, would go, Dad, how often do both of those things happen? Because that's the right answer. An insurance company faces this pattern too, right? They get small premiums and they pay a lot of money when someone dies. Not to be morbid about it, but a merger is a similar pattern. But the odds are on their side. They have to diversify a lot. If my daughter answered that way, I'd be the happiest debt. That has worked long term. It's failed in some crises. It's come back. The momentum strategy is absolutely unrelated to that one. They don't even look vaguely similar. So you put some money in each of these. Sometimes they all won't work. Sometimes the sum will be negative. You saw that. But more often than not, you create if what you describe is true, it's very good news. So these are very different things working for very different reasons. The fear is things look different, but are actually more driven by some underlying similarities. Because then you can have events we've all seen, famous correlation go to one type events. If things are truly economically different, then you're much safer. So we spend a fair amount of time trying to be forensic kind of, is there some way we're missing that these are connected? So we actually worry about the situation that's not what we just described. Please.
So how do you think about the huge growth in recent years of the ETFs or the low-cost index investing, like promoted by John Bogle, by Vanguard, or something?
It's hard to think about what it means for us. It gets back to, these questions are related. Are they arbitraged away? There are a fair amount of low-cost strategies, including some we run. We don't just do high-cost hedge funds. We do some of these too, that are applying these kind of tilts, usually in a long-only sense at a low fee. If everyone in the world tried to do it, it would arbitrage in a way. A lot of the money, two things have been winning in markets in terms of asset flows. Indexing in a Jack Bogle sense, which is actually very different. That is cap-weighted indexing. What you just described is often called smart beta. That's a term I literally fought this. I wrote about it. I hated the term. It's not beta. It's a small active bet added to the market. Eventually I caved. I actually wrote something along the lines of I cave on this term. And the reason is language is inherently a democratic process, right? If everyone else adopts a term and you refuse to adopt it, eventually no one understands what you're saying. You are the crotchety old man who will not use the term everyone else. So I still don't like it, but I caved. But so traditional active management, stock picking, has lost assets over time. It's gone to these two things: factor tilted portfolios and pure cap weighted portfolios. If it only, the net effect, the arbitrage effect on things we do depends on the net of these flows. If the active managers used to be taking a lot of value bets were taken off and they were put on in a more systematic way, but you don't really know what the net has been. Value investing in particular, I'm focused on that one. It's kind of, you know the old joke about the drunk looking for his keys under the light, and the policeman walks over and says, can I help you? Is that where you lost them? And he goes, no, but that's where the light is. I talk about value investing because I think we can measure it. But if value investing has actually had a bad kind of 5-year run, it's been a good 5 years for us because some of the other things worked to make up for it, but a bad 5-year run and is priced at historical average levels. I deduce from that, I induce from that, I guess from that these flows have on net not been away or towards value particularly. But over time, these factor portfolios, including ones we run, could be. I do not think they happened yet, but it could be this process that leads to Jane having a tough time when she takes over. And again, I don't know if I'm for it or against it. We'll have to see.
A few years ago,
you didn't know you were taking over? That's not like an official succession announcement. You know that, right? I'm getting to the age where literally like half the clients ask me about my succession plan. Secession would be if I was again leaving the union. But that really makes you feel old when like half the people say, so what happens if you have a really bad heart attack? What happens is I don't give a crap. No, I don't say that. I give them detailed plans. Yes, sorry.
A few years ago, Flash Boys was published, and sort of suspicion of high-frequency trading sort of reached its pinnacle, and you wrote an op-ed sort of defending the space.
I wrote 3 op-eds.
And I'm curious, yeah, whether your views have continued to evolve, and also what you foresee being sort of the future of high-frequency trading.
No, I don't know. I'll tell you, our basic point, I co-wrote most of these, we are not, just like I say, we're only a little bit of a hedge fund, we're not even close to a high-frequency trader. Probably the only way I got away with writing these is not what we do. No one, right or wrong, it's fair to judge people based on where their interests are, but also you tend to have an expertise in what you do. So we were kind of in a unique position that we have a number of people who do our trading who've worked at high-frequency traders, And we think we understand that world, and we don't do it. So we thought we were kind of allowed to write on it. Our view is not, and sometimes it gets confused, that it's a perfect world and these are all good actors and no one's doing anything bad or cheating anyone. Our view is we think we trade way cheaper than 10, 20 years ago, and we think a big part of it is high frequency. There is no perfect system. Very often high frequency is compared to a strawman that never existed of zero transactions costs, where you can get as much done as you want anytime you go to trade. That never existed. We've always had market makers. They used to charge more. That's really the only thing we kept writing. We can improve the system. If there are bad actors, we can get rid of them. But let's keep our eyes on the ball here. And the funny part is there is an argument. I believe even big investors like us trade cheaper. But there can be an argument about whether we do. Because if you're a big investor, it's not just bid-ask spreads and commissions. It's also, the big part of trading costs is market impact. So when you start to trade, you can't just get all of it done. You have to work that for a long time. And if you're big, you tend to move the price. So some make an argument that we're being short-sighted, that for really big traders, they don't trade cheaper with high frequency. And I don't think they're right, but that is a legitimate thing to argue. The one thing that everyone has to agree on is the little guy who goes on E-Trade and places an order does not have any market impact. You know why no one front runs the little guy? It's not because they're nice. There's no money in front running a little guy. You pay, depending on the kind of asset, bid-ask spread and commission. Those are way lower, and very few will argue with this, but almost everyone will agree that's a very big effect, at least from high frequency. So the person that we're all supposed to care about, in fact I hope I do care about, the small investor, is without a doubt getting a better deal. So again, sometimes you get put in a position, I would not defend everything. Sometimes I would get emails from people mad at me if there's a bad high frequency trader. See, I don't consider that proof the whole system doesn't work. Please.
You mentioned that you broke the cardinal rule of...
What was that?
You mentioned that you had broken the cardinal rule of quant trading. You had overridden the model during the GFC. Cut positions. I wonder if you speak to that a little bit more. And then a separate question is, do you have a theory or an opinion on the Kelly criteria and its use?
On what?
The Kelly criteria?
Yeah. They're related, actually. I would say there's two kinds of overriding of a model. One is you just have a different opinion. The model says that Amazon's too expensive, but you really like your one click and you enjoy it, and so you override your model. I don't believe I've ever done that. For one thing, I wouldn't call it a cardinal rule. We tell our clients when it comes to total risk, that is one area we will include some subjectivity. Not in direction. We will not reverse the trades. But if you're in a very aggressive portfolio, this is one of the things when I talk about, and one line I didn't mention, was not just high volatility, but aggressive leverage forces you to act differently. You might be willing to stick with any amount of losses. If your brokers aren't, you borrowed money from someone. You might not have a choice. So we actually, we actually, even there, we try not to do it subjectively. We have drawdown control rules, where at losses of a certain point, we will start to cut. They cost money. Over time, you tend to be cutting at the wrong time, but you have to cut to survive. You believe being more aggressive, you can make it back on the upside. In fact, when we do simulations, you do. But I don't think that's breaking a cardinal rule. I just think that means it's much, much harder to run very aggressive portfolios. Never cut, in a long only, beat the benchmark portfolio. One of the reasons those track records are phenomenal, never had to cut risk. And it's the same models. It's just done at lower octane, and the world acts differently. The Kelly criteria, for people who don't know, is a method where if you have a set of probabilities, how you should bet to maximize future compound return. In geek speak, it gets back to things I was talking about with how aggressive to be, and if you lose all the money. It's not just about, you could say, why not invest at 1,000% volatility to maximize future return? No, it's compound return, because you eventually, actually at 1,000% vol fairly quickly, you will lose all the money. And one negative 100% really screws up your compound returns. So the Kelly criteria helps you solve that. It actually comes out to be the average return minus half the variance. It's where you should do. The problem is, of course, you need inputs to that. And we live in, again, the real world. So if your inputs are off, and you have jumps, if you have crazy moves, you can lose it all even if you're optimizing the quote Kelly criteria. What I found with Kelly criteria is even investors who say they believe in it, who love it, who talk about it for an hour and show you the math, at the end have a line, and this is why we're at 1/3 Kelly. Because most people, some people have been famously successful. The Princeton Newport was a hedge fund for many years that supposedly, this is ancient history and I was not part of it, was very Kelly oriented, so there's been some people I think who have implemented it. I think most people look at it, solve for it, and go, what are you kidding me? And you do, with a lot of numbers and assumptions, it tells you to take 50% vol or stuff. I've told you I can't live at 20% vol when I thought I could. Kelly, for most people's assumptions of how good they are when they plug in like real world numbers, calls everyone a wimp. Just says you're way too low. And then people go, oh, that's really interesting, I'll do a third of that. So I love the math. If the odds were, if this was a discrete world and the probabilities were known, it would be a very safe thing to do and a very reasonable thing to do. In the real world, almost everyone seems to just haircut, and I think they're right for a lot of the same reasons I've been talking about. Please.
Risk Parity had such a terrible year last year. What's your outlook on it going forward?
Average.
Is the process broken, I guess?
That's I love that. I love that question. I never really know. I don't have a great answer. There are things that break in the sense of there's some reason it won't work for the next 10 to 20 years. I can't think of one. We are open-minded about that. I don't want to be completely dismissive. If something, and by the way, I think not just as often, probably more often, the time to ask if the next 5 to 10 years will be good or bad, or are you really worried will be bad over the next 5 to 10 years, is after a really good period. The world all asks that question after a tough period. We've done risk parity is for those who don't know, is instead of putting half your money in stocks and half your money in bonds, roughly speaking, and there are more asset classes than this, try to take half your risk at each. Bonds tend to be less risky than stocks in terms of any of the quantitative measures, and we can debate what the right measures are. Therefore, you put more dollars in bonds, and if you do that historically, a portfolio with more dollars in bonds is a better balance. It's more diversified. A portfolio with half the money in stocks and half the money in bonds, if stocks are 4 to 5 times as volatile as bonds, that's really a stock portfolio. Most of the way it moves is stocks. Therefore, risk parity is an attempt to equalize. Last year, it wasn't bonds, it was actually commodities, which is a part of the risk parity portfolio, part of most people's. Had a terrible year. You guys have all read about it. Commodities have had great periods. We've made money on risk parity over time. We don't, I gotta be very careful here, not in a legal sense, but to be precise. We do a bunch of different things. We do pure risk parity, which we think of as a very Jack Bogle kind of thing. We balance these exposures, we charge a very low fee, and we keep it balanced. Then we have everything else we just talked about. Last year, risk parity did much worse than traditional 60-40 investing, largely because of the commodities exposure. Anyone who hired us for the more active investing, value and momentum stuff, made a lot of money because commodities went down. This is not inconsistent. If you believe in an index over time and have a current view that's negative, you have the combination of those two things. So last year I was actually probably net thankful. Don't tell my risk parity investors that I'd have to explain that sentence at great length. I think they'd understand it at the end because I think it's consistent and many of them are in multiple products, so they've seen it. But the short answer is if something's broken, I have not figured out a way to know that. If you know that commodities are going to continue to go down by another half next year, it's probably going to be another bad year for commodities. If the other half of the world that said, if the Goldman Sachs who says it's going to come way back is right, it's probably going to be a very good year for it. I still believe in the concept that you should balance things by risk, not by dollars. So I think over the next 20 years it's going to win, and I can't figure out why it's broken. You know what broken would be for me? If we ever see that value spread that we're talking about. Cheap, expensive divided by cheap. go to near 1, I don't know if broken's the right word, but it's gone. That's a broken strategy that's not going to work anymore. We don't see any evidence. We see it as a bad year. I've, believe it or not, written a piece on the web on this too. It's never fun. I do write these in good years too, but no one's interested. It looks entirely normal. And the good year in many things last year looks entirely normal. Most of the time things are normal. Please.
In the fall, I got to hear Mark Carhart came on campus, and so a lot of the stuff was new to me. But I was wondering if you felt, and I asked him the same question, there's something to be gained as an operator or a pure value investor from what you do, whether it's the type of quantitative thinking or your view of the world. Can some of this be transferred?
To, in what? Is the question about what Mark would think, or do I?
No, I asked him the same question. I just want to hear your opinion.
Transferred to a different style, to another?
Yeah, like if there's someone, I know you said in the beginning.
I'll stick with that answer. It's very enticing, and about every 5 years I get enticed into some version of and someone else does it, but if you just give us your general advice, we'll use your stuff as a screen and we'll try to, and it's just, I'll stick with my answer. I think it's too much of a culture clash. But that's been my experience. Just because I haven't figured it out doesn't mean someone else doesn't beat me and figure it out. I don't know what Mark's answer was. I hired Mark and Coleman, by the way.
Yeah, that's why I asked. But I think he said mainly the same thing.
It's all very incestuous with Steve's student. I hired Mark.
He did mention that the momentum factor was, pretty strong for a value investor to know about, or at least think about.
Yeah, I do think that's good advice, and it's very. Funny is the wrong word because it's painful for a lot of value investors right now, but I've had a few kind of more old school, very good long-term value investors have very tough kind of 3-year periods emailing or calling me wanting to learn more about momentum. And I have a little more hope for that it might be useful. Not really trying to merge a process, just what does it say? It says more often than not, if it's currently plunging, there will be a time to buy it again, right? Now, in any one situation, you can be wildly wrong. This is 1,000 by 1,000. But on average, waiting a bit, giving up maybe a little upside, buying something. What does the combination of value and momentum mean? It means buying something cheap that started to get better. By definition, and value investors hate this because they all want to think they're buying at the precise bottom. You're always buying after you quote, miss the bottom. I think maybe there is a little lesson in that. Though, for people who buy 20 stocks, the specific stocks are so going to dominate their world that this lesson is still going to be a rather small part of their life. I even get scared giving this advice because even if the advice is right, the chance I make their life worse is about 40%. Because they're so specific to what and so non-diversified. That there's, you never want to give advice. I've learned over time, and this is again not legal, this is just personal, to give as little financial advice as possible, except in one instance where I learned the opposite. I have an aunt who lives in Australia. More accurately, I have an Australian aunt who's a little crazy, I have to say, and in a lot of ways. But she, for about 15 years, would call me once a year. She'd kind of leave Australia. Wherever she was going, she'd want to know what day she should convert her Aussie dollars into whatever currency she was going. And for about 12 years, I stupidly gave her a speech like I've been giving you guys. Well, and Cynthia, that's her name. We do have a view on currency. It's been so much easier to say we don't do currencies. But we do value and momentum, and there are 25 currencies, and we have a 51% chance of being right about any individual currency. And she just thinks that I knew and wouldn't tell her. And finally, I hit on the strategy about 3 years ago. It took me this long. When she goes, all right, I'm going to Thailand in 3 months. When should I convert my Aussie dollars to the baht? I now say something like 2 Thursdays from now. What I figured out is this makes her very happy. She doesn't check. I don't check. It's not bad advice because it's as good advice as any other day. I'm actually not. If I were hurting her, this would be a moral dilemma, right? But I'm not, because she's going to convert it on one day anyway, and I don't know, and nobody knows. So I solved the entire problem. Thursday. She has not noticed it's always Thursday.
We're about out of time. I'm going to ask you the last question.
Sure.
Tell me a little bit, you've been very successful over these years. Tell us a little bit about what it's been like personally for you, maybe some of the ups and the downs of being a successful public figure.
I have not, anyone who watches me will know this in very quickly, but I should have learned this lesson. You gotta be more careful about what you say than you ever realize, especially nowadays. And I have no idea what I said tonight, but I'm sure there was something terrible in there and I'll get in trouble for it, and Jane has written it down and I'm gonna have to deal with it. That's an unpleasant surprise. Mostly it's fun. It never, there's a saying of Winston Churchill's I like a lot. And I'm going to mangle it. I'm going to get it approximately right. And he said it when they were winning the war. Later in the war, he said that the problems of victory are more pleasant than those of defeat, but no less difficult. And you get problems every day. You walk in, someone's unhappy every day. You learn that you are a manager now, something you've never dispelled, showed even the slightest skill at, which Jane will also testify for me on. I, for one, I don't feel at all done. I think I think a lot of driven people probably have this. This is getting weird because you're getting me into my own. It's like at the end, I'm ending with on the couch here, but I still feel like I got a little chip on my shoulder and something to prove, and that doesn't go away. And I would have forecasted it would have gone away by now, but maybe it never goes away. I was waiting for it to go away for quite a while. And at this point, I think I'm stuck with it. And that was an odd realization. Contentment has not kicked in. But I do think there's a little bit of evolution going on there. If you're wired for contentment, the perfect life, I don't know what the perfect life, but a perfect path would be wired, not to be wired for this until you achieve a certain amount of success. Then have your internal wiring completely changed to someone who can say, oh, well, this is great. Doesn't usually work that way, and has not worked that way for me. I wish it did a little bit more, I'll admit that. So we have ended with Steve making me sad. Thank you, guys.